Okay, Matt the Mortgage Guy here. Today's video, I'm doing an update to my original update. Last week, I brought to you this lender letter that came out from Fannie Mae, how that is going to affect investment property loans, how it's going to affect second home loans. And last week, all we really had was this lender letter from Fannie Mae telling us that they were going to make some changes going forward. As a lender, of all the loans you send them, not more than 7% can be these types of loans. Second home investment property loan. Now, before any lenders had a chance to react, I let everybody know, and I made a video, I'll link down below, what I thought was going to happen, how lenders were going to react, what they were going to do. Some may tighten guidelines, some may raise prices, so on and so forth. So here I am 5 days later, providing an update, telling you as a mortgage broker what I've heard from different partners. Some of them that have changed pricing already, some of them that plan to do it in the future, some of them that talk about different loan level price adjustments, which basically just means the loans get more expensive in certain buckets, right? So anybody who didn't catch last week's video, I encourage you to go watch it, but I'll give you a 30-second snapshot. Fannie Mae, who basically is Fannie and Freddie, are the government subsidized entities that buy all the loans on the secondary market from all the lenders that write them. You go get a loan, mortgage company XYZ writes the loan, gives you the loan. They package that up with 100 loans that look like it, and they sell it to Fannie and Freddie. So Fannie and Freddie, being the buyer of all these loans, they make the rules. That's the easy to understand version of it, right? And they tell you how much you can buy loan to value wise. They tell you what credit score you have to have. They tell you all kinds of stuff, on how we can calculate your income, how we verify your assets. And that's how the rules are made. And then, we go out and write these loans, fit it in their box and sell it on to them. So anyway, enough with that. A real quick example of what they're saying is they're saying that, and they're saying this to all lenders, if you've got 1,000 loans that you're selling to us, not more than 70 of them, 7%, and that's what this document over here says, can be secured by second home and investment properties. And I did a little bit of research, and I can tell you that currently the average is about 9%. 9% of loans that get written are investment property or second homes. So what does this mean? Certain lenders have 11, 12, 13%. Other lenders have 4, 5, 6%, right? If it's an average of 9, Fannie Mae is saying, Home Point, United Wholesale Mortgage, Sierra Pacific, Caliber, whoever the different lenders are, 7% is your cap. So what's going to happen? It's really rather simple if you think about it. The lenders that have 11, 12, 13%, they need to pump the brakes and write less of these loans. What's an easy way to write less of these loans? Charge more. You charge more for anything, you're generally going to sell less, right? And so we're already seeing that. I've seen, especially from the lenders that are, historically the best priced and the place to send investment property loans to, they've already pumped the brakes significantly. And I can give you a quick example. I've got a client who's going to sign today, and it's a cash out investment property duplex. I went in there and priced it. And basically, for that same exact loan, 3.125% is what he's signing on and paying a couple points. If he wanted to do that same exact loan today and pay the same amount of points, the rate would be closer to 4%. I mean, that's a huge, huge jump. And so that's what they're going to do. Other lenders I work with that don't do a lot of investment property loans are like, hey, nothing's going to change for us. We're well below the 7%, so nothing's changing for now. What my thought is, and I've talked to a bunch of high-level mortgage folks, is that the folks that are writing a lot of these loans that have changed pricing drastically worse are going to creep their number down to 7. Ones that only have 3% of their loans as investment property or second home are going to now become the best price, and their number is going to rise to 7 relatively quick. And so they're going to have to add these loan level price adjustments and charge more. Just something I popped up here on my other screen that you can't see because I'm sure lenders are getting a ton of these questions. I got a response that's just a response to all the brokers who send business to this specific account executive. Are we going to implement additional pricing loan level price adjustments for investment in second homes, like many of our competitors did. And this just came across my desk this morning. Yes, we likely will be. No, I don't know exactly when. No, I don't know exactly how much. I'm not sure how much notice I will have, if any. And so that's the kind of stuff that's coming over to mortgage brokers and mortgage professionals from their account executives, is that they don't know when or how much notice they're going to get. But this letter basically said April 1st, stuff getting delivered to Fannie April 1st. So stuff that's closing mid-March, that's already foregone conclusion that they're going to have to abide by Fannie's new rules, because it won't get packaged up and sold to Fannie until after April 1st anyhow. So it'll be interesting to see, and a couple things to just kind of chew on here. And I've gotten feedback on my YouTube channel. I've gotten feedback talking to real estate agents and investors and other people. This is something that you kind of wonder what the internal dialogue is at a big mortgage-backed entity like Fannie and Freddie, right? Are they seeing data that we haven't seen yet that lends them to believe there's going to be higher default rates in the investment property pool of loans? Are they seeing something on the horizon with the number of people that are in forbearance and not paying rent? Investors, mom and pop investors that might have to work 2-3 months on evictions in some of these states where evictions are a little bit harder. And they're just going to say, forget it. I don't want to deal with all that. I'm just going to sell my investment property. Or they're going to, get in default themselves and maybe just let some of these investment properties go, and they're going to foreclose at a higher rate. And that's why they're adding all these things that are going to basically make it more expensive to write investment property loans. All interesting stuff. All stuff to keep an eye on. Here's something that I want to get across because I think it's really important. This has the potential to affect the real estate market. I think everybody kind of understands that, right? And I've heard some lender friends talk about how good this will be. Their owner-occupied buyers will have a better chance to get something accepted because it's going to be harder and more expensive to buy something as a rental property if you're not buying it cash. If you're getting a loan and it's going to Fannie Mae, Freddie Mac. I've already heard that, who was it? Maybe I shouldn't name the lender, but a direct lender who's in our market has capped their investment property stuff at 60% loan to value, meaning you'd have to put 40% down if you wanted to buy an investment property with them. Some of the big banks, Chase, aren't doing investment properties at all. So the lending is becoming more restrictive. Now, that helps somebody who's buying a home owner occupied because it limits the buyer pool. So it's a good thing, I think, for a lot of home buyers who aren't buying investment properties. They're just buying it to live in it. Maybe not dramatically, but it'll at least shrink the buyer pool to a certain extent, right? One thing I want to get across, and then I'll cut this thing off, I don't want to get too long-winded, is literally this letter from Fannie Mae and their changing of how they do business, who they're going to, accept business from and what percentage and whatnot can affect the mortgage market. I want people to think about what happens if 3 months from now, Fannie Mae says, hey, on owner occupied properties, we're going to change our debt to income ratios to 40%. You're going to have to make more to buy this house, or you're going to qualify for less because we're going to get more restrictive in our guidelines. Something like that, that's pretty dramatic, where, somebody might be able to go up to 50%. Now it's 40. But just for simplicity purposes, if somebody's qualified for $500,000 and the limits got drastically changed like that to 40% debt to income, it might lower their purchase power to $420,000, much less. So some people would either qualify for much less, not qualify at all for what they're trying to buy. That would drastically limit demand. That might be something, who knows, right? It's a scenario that could happen. It's a scenario that, for a lot of folks would be helpful, because then they would be able to go and put in offers and be against less offers, less competition in getting a house. For some people, it's really going to hurt. It's going to sting because they're not going to be able to qualify at all. But all stuff to think about that, there's certain entities, and Fannie Mae is certainly one of them, that with the changing of a couple rules can can quite drastically change real estate. And for everybody who's thinking that, real estate is on this crazy run, it can't last forever, and, it's unsustainable and things are going up 15% a year, something like this, the restriction of mortgage guidelines or the pricing of loans, rates getting more expensive, could be our black swan, right? Who knows? All right. Thanks for watching. I appreciate you. If you made it this far, you must have found some value. So consider subscribing to the channel. Hit that like button. It really helps more people see this. Hopefully this information was useful to you. And thanks for watching.